Good afternoon, everyone. Great to see so many of you here. We can now say that stable coins are moving trillions. Exchanges are exploring 24/7 trading, and more assets are going on-chain. The question is not anymore whether market infrastructure is changing, but how deep and fast the transformation will go. And that is exactly what we want to discuss together here today. So welcome to our panel. How does the role of market infrastructures evolve with the convergence of crypto and digital securities? I'm Sven Wagenknecht, Editor-in-Chief at BTC-ECHO. Great to be here. And now I would say let's start with a little introduction round. Maybe Marianne, you start.
Sure. Hi, Marianne Weber. I'm the Head of Market and Regulatory Strategy. Do we need a mic? Yeah. Hello, hopefully that's okay. Hi, let me start again. Marianne Weber, I'm the Head of Market and Regulatory Strategy for Digital Assets at Standard Chartered. My main focus is really on all the regulatory engagement that we have to do as a bank in order to execute on our digital asset strategy, which can be anything from licensing through to trying to influence the incoming regulatory environment for digital assets. And together with the team launching a very exciting range of digital asset products and services. Thank you so much for the invite to be here today.
Well, hello again, everyone. Marco Kessler. Maybe to explain a bit more than before, I have a dual role at SIX. On the one hand, I'm head of SDX, the SIX Digital Exchange. On the other hand, we announced last year that we are integrating SDX into SIX, into the main business, if you like. So my role is also to oversee all the digital initiatives, the integration and all the digital initiatives in the security services area. And I'm very happy to be here because, I just had the keynote before about it, but happy to share also a bit more details about our ongoing integration and how do we want to make it reality to converge to the topic the colleague mentioned before, to converge crypto and digital securities under one umbrella and offer to the full market, so wholesale in that sense. So, thank you.
Hello everyone, I'm Clarisse, CEO and co-founder of Dfns. We're a wallet infrastructure provider for financial use cases. We serve banking and payment use cases mostly. We've been transacting more than now nearly $100 billion of volume on our platform with more than 50 billion euros. I should get my euros and dollars straight on a monthly basis. We work with players like, we work with pretty much banks, PSPs, tokenization platform, trading platforms, players going from Broadridge to Stripe. And we've been very much focused since pretty much the past 6 years that we've been building into providing an API-first infrastructure modular enough that can fit with all the constraints that our clients have as they grow the number of use cases and they grow also their platform globally and need to adapt to different regulations. Very pleased to meet everyone.
Hello. Okay. Hello everyone. Donc David Durouchoux, I repair the mics, and I'm Deputy CEO of Société Générale Forge as well. Since 2018, we are active in the tokenization space. We've made as well a lot of transactions using CBDC within the Eurosystem trials. Since 2023-2024, we are a banking-ready issuer of stablecoins, which are denominated in euro and in USD. And we are at the moment engaging with liquidity providers on the crypto side. We are as well engaging with DeFi. Let's say as a fintech, but as a subsidiary of a bank, we want to have one foot in the TradFi, one foot in the DeFi. And we think the bridges should be developed. And I think we, as a bank, is part of our role to do this.
Thanks, David. Georg Schneider. I head up our RWA go-to-market at Digital Asset. Digital Asset is the company behind the Canton network. You might have heard the name. We are working with the financial industry generally to bring them onto new rails. I think we work with every one of these firms on the panel, except for you, Marco. We need to talk about that. So really actively trying to bring some of the most used collateral, government securities, on-chain, tokenized deposits, various forms of margin collateral, and really trying to sort of grease the machine of financial markets by leveraging this new technology. I'm very excited to be here and looking forward to the discussion.
Thanks for introduction. To kick off things, I would like to start with a little icebreaker question for each of you. And therefore, I would like to know, think of one moment from the past 12 months that made you say, okay, Convergence is really happening now. It could be a client call, a deal, a headline, whatever comes into your mind. Okay, so maybe Georg, would you like to start from there?
Well, that's an easy one for me. That's probably the day that we signed the deal with the DTCC to bring US Treasuries onto Canton. To me, that's sort of a seismic shift in the industry and really unlocking a lot of the value that comes with on-chain transactionality. There's probably a second moment happening, I think, tonight or tomorrow that you'll probably hear, which I can't share yet, but that's of similar scale. And I think to me that represented the willingness and the ability on the back of the no action letter that the DTCC got to put these assets onto a public chain. To me, really represented the two worlds coming together and people really having that comfort of the largest CSD in the world being active and actively using these new networks.
Donc for SG Forge, it was this transaction with DRW we are very proud of in the US. We think it's the start of really US engaging with digitalization. They were a big lacking behind since a few years and were, let's say, not really happy to see that because US for us is a big market, obviously. That's so good news that we achieved that transaction together. And the other one would be the partnership with Deutsche Börse Group that we signed in December 25 to, let's say, distribute stablecoin and tokenized money at all levels within Deutsche Börse Group. Deutsche Börse Group is a big partner of Société Générale, the bank. So here we are starting to have the tools to automatize a lot of things. Of course, the trading part and the market part for the settlement, etc. But as well with Eurex, we are working with Clearstream as well. Donc, and we see this group is really having a very strong strategy of digitalization in the coming years. So that's very happy to see that in Frankfurt.
On our side, we've announced a few months ago, back in November, that IBM is entering the space of white infrastructure, and they did so by white labeling our technology. So obviously, we're personally very happy. But beyond that, when we started building this infrastructure, we built it with really much bank adoption in mind. And for a lot of tier 4, tier 3, tier 2 banks, knowing that a player like IBM can power such a critical piece of their infrastructure is a big way to alleviate the pain of entering the space, right? And so for us, it was very critical because it was, for once, a massive reach to be able to unlock some of the hardest decisions some of the tech people have to make between some different startups. Suddenly you add IBM providing, or you have now IBM providing a product to teams that they've known that is compatible with technology that they've been pretty much using for decades. So making sure that we can build this new finance industry by transitioning with the existing back-end technology of our clients.
Well, for my side, definitely November last year, early November, about the 10th or something, when the new strategy, digital asset strategy at the group level was signed off, also determining that we want to enable the tokenization of 7 trillion of assets held under custody, in principle, similar to a DTC moment, maybe a smaller scale for sure, it's Switzerland and Spain, but still quite significant. So definitely that. There is a second one, but not allowed to talk about it yet. You will hear about it in 1 to 2 months, something like this. Thank you.
Exciting. Is that working? Yeah, it is. I think for Standard Chartered, I would choose our announcement last year around launching our crypto trading capability for our institutional clients, which was effectively adding spot Bitcoin and ETH to our FX trading desk. I believe we're the first globally systemically important bank to have that capability. And also, I think the first and only bank to be registered with the FCA as a crypto asset exchange provider. So I think for me, that was a real moment of blurring the lines, let's say, between TradFi and crypto native capability. I think what's also interesting is our existing risk management, governance and frameworks actually allowed us to get about 80 to 90% of the way there from idea stage through to actually launching that capability. There are, of course, novel and nuanced risks that this asset class poses, and we've had to make significant upgrades. But what I think is interesting is overall, as an organisation, the ability to bring that to market has been there, which has been a really excellent thing to be a part of.
Yeah, many great milestones. And now I would jump into the discussion. And therefore, I would like to know or talk about the separate digital exchange model. So where we have a digital exchange next to a traditional or main exchange. And my question is, isn't it just temporary that at some point we have to merge everything? And I would like to know from you what's your opinion on that and how long does it maybe take?
Thank you. It's a very good question, and well, I'm happy to share our experience. Of course, I mean, I know there are other players out there doing their own experiences, but to share ours, yes, we did start as a separate stack completely. So if you look at the exchange layer, at the trading layer, clearing layer, we didn't have because of the model, the settlement layer, custody, and so on. And well, with integration announced last year that we are executing now, actually, we realized that when a certain, in my view, when innovation reaches a certain level of maturity, then it's useful to rethink whether you want to transition, remove the old, and start just with the new, or to merge to facilitate the adoption and remove barriers to entry. And that's what we decided to do, to say, well, we don't, SIX Group, as I said before, I introduced it before, in Switzerland we have two separate financial market infrastructures. For a market like Switzerland, that's quite a lot, from client perspective, to decide, to onboard, to sign contracts and everything with two separate infrastructures. So we figured we want to be able to offer one plug to two worlds, basically, to be able to offer not just to our participants on the digital side, so to say, the capabilities, the digital capabilities, but to offer them to all the market participants in one go, basically. So what I said before, to allow any participants of the Swiss market who's already connected and established a relationship with the financial market infrastructure since decades, to just be able to opt in and access digital services. And to the topic of convergence, when I say digital services, we consider also crypto services. So we are looking now, and may or may not have something to do with the announcement that I mentioned before coming in a while, we want to also offer crypto services out of the same plug, out of the same relationship, out of the same channel. It's a bit, my keynote before was a bit of a roadmap of sorts of what we're doing, actually. And to the question of your timing, very soon. I mean, it's a this year kind of thing, okay. Much earlier, yes. So we feel this will be, I mean, we hope and we believe in this transformation giving a big boost to adoption, because I'm quite convinced there are many participants out there who may be on the fence right now, who may be thinking maybe yes, maybe no, maybe I have demand, client demand, but maybe not enough to justify an own solution or investment into this. But if you can just tap into an existing kind of familiar setup, a relationship, contractual relationship as well, and just turn on the service or then turn it off again if you don't need it later on, we feel this will facilitate access much, much more.
Exchanges are moving toward 24/7 trading. what do you think? Will this continuous trading become the new standard for all exchanges or for all asset classes? Is this a new normal 24/7, or is it just like a specified thing? Everyone who wants, it's open.
Well, I mean, very briefly, and then, I mean, I want to give option to the other. Very briefly, I think it will be a side-by-side thing. It will not be a replacement in that sense. I think it's not just trading on exchange. It's just operating models 24/7. I think they unlock new possibilities in terms of availability, in terms of global models that allow 24/7 apply to different time zones rather than availability throughout the night, so to say. So I think it will be a parallel thing.
Well, we can do a comparison with the move from a T+2 to T+1 settlement and the question of the T0, which comes especially from the US. I think if we are just using traditional capital markets, maybe the 24/7 would not be a good idea. Because for those who know back office systems, etc., you need time to, let's say, solve a part of the inefficiencies of the problem, like cash settlements, all the breaks you have, all the fat fingers, etc. Donc usually it's a kind of oil in the system to have a settlement which do not arise in real time. Moreover, there is the question of the credit, which is behind. So if you don't do credit, you don't have markets. Pre-funding is not, let's say, a scalable mechanism. But the problem is if you want to do crypto, the norm in the crypto asset space is 24/7. So at the moment, we are, let's say, distributing services and stablecoin into DeFi pools. What we want to achieve is to bridge DeFi pools with fund shares, tokenized fund shares. That's the big trend, tokenized money market funds, etc. Question is, what do we do for 24/7 with a DeFi protocol which is truly 24/7, a cash leg which is stablecoin which is true 24/7, but the fund share which is not. So how do you bridge and how do you bootstrap the liquidity on the asset side? And that's something which we are looking at the moment. I think that if we can crack that, I think we have a true bridge between TradFi and DeFi for the benefit of the users, which are, in that case, at the first crypto users, but which can be more, in that case, traditional users, high net worth, etc., etc. And that could be, let's say, the next step. But we have to think it from a banking and FMI side, because it means a lot of things in back office, etc.
Maybe to add to that, when you mention sort of 24/7 markets, I don't necessarily associate that with the literal capability of buying a stock on a Sunday morning. I don't think there will be much liquidity nor demand to do that. I think of 24/7 markets more as just the 24/7 mobility and the ability to move and direct my assets during hours which I normally can't, right? And that by itself, to me, has already vast implications for how firms operate and how much excess collateral sits in every kind of venue and silo. So if firms can, globally operating firms are already in the 24/7 cycle pretty much, right, across the different time zones. And if they now also have the ability to have the collateral sort of in a follow the sun model move around and remove those access buffers, that by itself has a massive implication on capital efficiency. And so, yeah.
Okay. So it's not only about more liquidity or more like volume, trading volume, it's also about like a kind of globalization of markets, which is then possible if we have 24/7 and via an open blockchain standard that it's easy to have this global framework. That's maybe the point. I would also like to know, are there any risks when we have 24/7 trading, real-time settlement? Is it only positive, or are they also, because we humans are not awake all the time and everything, so the human as a risk factor maybe as well in the infrastructure. Is it a risk?
I'll probably start by saying I don't see sort of, let's say, specific risks, but there's definitely a lot of operational challenges to be able, in terms of, funding trades, and everything becomes much more immediate and instant, and that obviously presents big challenges to any firm that is currently just operating kind of on a day-by-day cycle where they have to plan sort of a day ahead, and so I think it's more that these operating models need to be defined and implemented. and that carries some challenges with it.
I think just from, it changes the competitive dynamics really in terms of as a bank what we're operating with. I think we've seen such significant growth, for example, of stablecoins because of that 24/7 and the ability, the use case for stablecoins to be used for cross-border payments and other TradFi, let's say, services is the expansion of that in a very short space of time is quite astounding. So the fundamental threat that poses to incumbents is certainly not to be ignored and something we're certainly considering how we participate in that ecosystem. So for me, I think the biggest risk, if you like, is the sheer shift to competitive dynamics that we're seeing.
With the change of the market infrastructure, crypto exchanges also increasingly offering banking services like debit cards or payments. And I would like to know, could banks lose significantly maybe market shares to crypto native, like exchanges, for example, because they are stepping into their market and offering similar services because of the new infrastructure? Is it a risk?
I can take that one. What we see, we service both crypto scale-ups, fintechs, up to banks, right? And what we're seeing, what the trends we're seeing today, and then mostly that has happened over the past 12 months with the surge of usage and use cases around stablecoins, is that you see both neobanks, payment providers seeing their stack collapsing. So pretty much you had payment providers that were offering the ability to pretty much on-off ramp to certain, on the cross-border side, to certain currency. You had payment providers that were sitting at the acquisition. You had payment providers that, you had banks that didn't have payment capabilities but were offering wallets and I would say the former term, the traditional term of wallets to their clients. And pretty much today, Revolut, now that Revolut has wallets pretty much in all its back infrastructure, can do payments, can go on the cross-border payments. Payoneer, that is a cross-border payment platform, can offer a wallet to its suppliers, and suddenly it becomes their banks, right? Because they can also offer some yields attached to the balance that are staying in those wallets. And so you really see that, that stack collapsing at the wallet level, which is if the wallet is my relationship with the end user. From that wallet, I can pretty much service my clients with many financial services. So I don't know if it's a risk because, once again, those players serve function in our market, right? And so I don't believe that, and I actually deeply believe that lending is what will stay core to banks and will keep banks being bank for a while, because you need to have that capacity and all the regulatory requirements around lending, but that's the core of the relationship. But on the neo-banking and payment stack, yes, you definitely see those players collapsing their stack around the wallet capabilities.
Well, we've seen new banking services, but at the start, it was not banking services. It was DeFi, stablecoin, etc., liquidity providing, and all this was very siloed. And what we see is a convergence and of those services into only one offer, some portals, because big actors are progressively integrating those services. If you start with custody, then you can propose stacking, then you can propose market access, then you have your own stablecoin, or you do a partnership, etc., etc. And I think that there is here a convergence which in the end, let's say, start to eat in the plate of traditional bankers. And that's precisely where we see it as a traditional bank, Société Générale. We issued a stablecoin because we saw that some non-regulated firms, Tether, Circle, for instance, were engaging with private money, which is a monopoly of the banks. So you see here, those non-regulated actors are eating in our plate, even if it is a regulated service, because basically they are operating from offshore, or they are more efficient, or etc. Donc we should absolutely transform ourselves in that case. Donc I think we have everything on the table to achieve that transformation. The question is, can we do it as a regulated actor, as a bank, voilà, etc., etc.
Yeah, just to add to that, yeah, no, I'd agree with that. I mean, I think it's clear that some of the crypto-native infrastructure does clearly outperform some of the legacy rails. I think it's difficult to argue with that. I think it's more about sort of coexistence rather than replacement. I agree. I think there are some fundamental services that particularly large institutions will still turn to banks for in terms of risk management, in terms of credit creation. I think there's absolutely still a role there for the banks. So, yeah, coexistence, I would say, going forward.
And maybe just to build on what I was saying, because there's actually a use case that is immediately eating on the banking capabilities, which is actually growing fast, which is large fintechs, large neobank issuing stablecoin not to distribute in the market, but really to pretty much process all their internal payment themselves. So you remove your banking relationship on the cash management side for everything that is internal. And that is happening today. Revolut is issuing a stablecoin not because they want to conquer the DeFi market, because they want to optimize their processes.
Talking about infrastructure, I would like to know, do we still need central securities depositories, CSDs, in a fully tokenized world? Do we or not?
Well, I certainly have an opinion on that. Contrary to a lot of the, I guess maybe, let's call it ideologists that think of a completely disintermediated world, I think all these roles exist in the market for a reason, and you know have grown. These roles have grown over whatever hundreds of years in terms of where they are today, and I don't think that role necessarily changes, right? While you know you could argue that blockchain rails could technically allow you to disintermediate, I don't know, a bank or a custodian and do self-custody. There is a very good reason why these roles exist, and they will, I strongly think they will continue to fulfill that function, right? People are not comfortable, you know, taking the risk and dealing with all the complexity of self-custodying assets. They want somebody to take care of that and just provide them with a sort of a nice experience around it, and that's where the custodians will continue to play that role. Just on a new asset class. There's certainly certain areas where you know where there's intermediaries that exist for no good reason in a sense, and maybe cut into some of the margin, and there we might see some consolidation. But other than that, my goal is really that to bring financial markets as they function today onto these new rails, and that already unlocks enough of the value of this new technology, so we don't need to kind of reinvent everything while doing so.
So I see that Georg really wants us to join Canton Network, and I think he passed the test today. No, but I feel a bit called, obviously, into question, and to be honest, I would say, I mean, I agree with what Georg says, that really we didn't discuss this beforehand. I would say in a theoretical world, no, you don't need them. In a theoretical world, you don't need also other things like, I don't know, investor protection, for example. If everybody does the right thing at the right time, all the time, you don't need those kind of things. However, to me, it's a conversation that starts without even looking at technology. You go back 30 years, 20, 30 years. And, you know, in principle, of course, the market can have bilateral agreements, multilateral agreements, so agreements with every single, you know, full mesh kind of network, and agree on all the things and all the processes and so on, and build it that way. It's possible, independent of blockchain, DeFi, or anything like that. It is possible. Is it useful? Is it efficient? Is it meaningful? Is it safe? I don't know. Probably not really. I mean, that's been a question answered years ago, decades ago, actually. Now, on blockchain, well, we believe as well, actually, that blockchain offers a great mutualized infrastructure, mutualized technical infrastructure, and this is great for everyone, because I think, you know, in that world, you don't have to, every institution doesn't have to cater and maintain and build and curate their own infrastructure, investing lots of money, everyone investing their own money pot, basically, but you can ideally share some of that cost across, mutualized. But that's the technical layer. Then there is a governance layer, which is the whole story about providing a service, providing a business service, providing safety and so on. I mean, I can pass the keynote text before, because it's all the things that are described there are basically what we see as the value we bring to the market. Finally, obviously, it's the market to decide, whether the proposition offered is useful or not.
Maybe one last angle here. I think what we see from when we look at what DTCC, Euroclear, and Clearstream are working on, I think it's interesting because they are very much just transitioning their role as financial market infrastructure, building financial market infrastructure for banks to be able to actually tokenize within their platform their assets. And I think that makes a ton of sense. And not all the banks, not all investment bank capital market will have their tokenization market infrastructure. They will actually issue their asset directly at the CSD level, so at FMIs, which will be really much accelerated the adoption there.
The problem of tokenizing as a bank, when we started tokenization, we did a super nice work of, let's say, putting engineers, lawyers, etc., in the same room, issuing on a public blockchain as a bank, etc. But in the end, it costs so much that you wonder if it's, let's say, financially efficient. And the problem of the answer of the CSD is precisely when you have a utility and tokenization itself becomes a utility, the marginal cost should, let's say, converge to zero unless you don't have a model. And precisely, I think the answer of the CSD, beyond the regulatory aspect, because you have a monopoly of issuing securities, etc., bringing liquidity. Donc, that's a true legal monopoly for financial stability reasons, but you have as well cost reasons. Because tokenization, in the end, is not the end game. The end game is funding yourself, serving your clients, etc., and that should be done at zero cost, at least. Like, I think CSDs are here as well for that. We are looking to you. to tokenize precisely for that.
Economies of scale.
Tokenized collaterals are a major topic right now. And I would like to know, how does on-chain collateral differ from traditional collateral management? Where are like the main positive effects?
Well, I already hinted at this earlier, but it's the instantaneous nature or the timely nature of settlement. And in the context of collateral, that has a direct value for everyone involved, right? It's on the one hand, the example that I gave, allowing for the collateral to move kind of around the globe in different venues, but also it removes some of the risks, the inherent risks in markets, right? If we consider like how people manage, margin today, it's on a daily basis. It has sort of this 24-hour 24 or 48-hour delay, right? So your risk window is around that. And then you bring in this instant settlement capability, and that shrinks that window of risk that you have to look at in terms of your exposure, right? It could shrink to maybe an hour or even minutes. And that ultimately allows people to reduce maybe the margin requirements and give people more trading capacity through that. So I think that's ultimately the unlock that you get from tokenized collateral and generally anything that's usable in such a context. And some of the other implications are, the timeliness of financing operations. You can sort of just in time, finance using your on-chain treasuries. So I think that there's a lot of things that are just not possible in today's world because we're in this sort of 24-hour cycle in a sense that unlocks, and I'm really looking forward kind of to see that come to fruition and to realization. I think right now we're in this phase where everybody sort of gets operationally ready to deal with these sort of new timelines and instant nature of things settling and changing. But once people are ready, then we'll see some actual scale coming into this.
Talking also about like the money side of assets, so about stable coins, tokenized deposits, CBDCs. I would like to know from you, do you think there will be one model that is dominating, that this is like the standard for settlement, for example, or will it be a mix, a cocktail of these different kind of opportunities?
Ouais, bien sûr. What's that? No, I think the question of the dominance for now is an historical dominance of Tether and Circle. What is interesting to look at is, as you were saying, it's a EuroC. How the Circle comes on the European market. And you can look at the volumes are not so huge when compared to the USD one. So it demonstrates two things. It's a market, even for Circle, which is complicated to engage with. For a reason, one of the main reasons being that 70% of the market is automated at the moment. So when you have a bot which is trading based on USDT, USDC, you won't change it unless you have a lot of incentive for EuroCV, our stablecoin. Donc we have to bridge and to touch base with those actors to say, well, you have a vault with a set of assets. This vault is cleared using a certain stablecoin. We want Convertible to be part of this market, so we will help you to build this vault. This is complicated, you have to seed, you have to find partners, etc. And so penetrating this market is relatively difficult. That's the first aspect. And the second aspect is it depends on the use case. I've heard a lot of stances, especially even at the ECB or at the EU Commission, saying digital euro will protect citizens of European countries from stablecoin, dollar stablecoin. It's obviously false. It's not at all the same use case. On one hand, you are touching base with crypto actors, crypto clients, DeFi, etc. And on the other hand, it's a payment mechanism rolled out internally onshore for the citizens of the European countries. Donc, the question is the use case. If you are going crypto, fine, you absolutely need a stablecoin. If you are more doing interbank settlement, maybe fine with tokenized deposits or even Euro, CBDC or whatever. Voilà. So I would not say, and in the end, just to be clear, if there are some regulators in the room, as a bank or subsidiary of the bank, we are really committed, let's say, to being anchored on the central bank money, which for pure financial stability reasons are very important to keep. So we are really a fan of wholesale CBDC for interbank settlement on CSDs, etc. That's very important to say.
Yeah, I think I'd agree with that. I think settlement is going to be multi-money going forward, and we're certainly building in that optionality into our strategy. I think as you rightly pointed out, it's the right type of money for the right use case. I think stable coins we're seeing very, very significant demand from corporates, FIs, and crypto natives. That it's a very diverse client needs there. I think tokenized deposits solves a slightly different problem. I think you've got programmable money there within a sort of regulated sphere. So you preserve the deposit insurance, the KYC, etc. And that's certainly appealing for certain parts of the ecosystem. I think limits there, though, in terms of can it scale cross-bank and cross-border. And CBDCs, I don't really see CBDCs as competing with private money. I think the purpose, what central banks want, is more efficient wholesale settlement and monetary control, essentially. So I think that will exist. I think questions around the use cases for retail CBDCs in the majority of markets. We haven't really seen significant scale outside of China for that. So I think multi-money, I don't think there really will necessarily be one dominant form.
I see, for example, the whole question around tokenized deposits versus stable coins and so on. Actually, in the light of commercial bank money pretty much runs the world today. But by far the biggest chunk of transactions happening in commercial bank money, and tokenized deposits is just an upgrade of that rail, right? So for all the activity that happens in the, let's say, the real economy, a stablecoin actually signifies onboarding friction because they need to establish the stack to be able to deal with the stablecoin. So a tokenized deposit is a much shorter path for like an industrial or so to actually make use of these new rails. And I expect once you have sufficient banks offering that and everybody sort of is on these new rails, that actually that represents a significant share of the activity there.
Are institutional investors starting to adopt DeFi yield strategies like staking or liquidity mining? Is it a topic for you? Do you see the demand right now for these kind of yield strategies, or is it too far away from institutional perspective?
Alors for the moment, what we see is still very retail. It's a really retail strategy, and because precisely of the structure of the stablecoin. Alors here we are fully crypto. We don't speak about tokenized deposits or private chains, etc. Fully crypto. Donc why? Because basically stablecoins do not distribute any yield. It's not on the plan. I've seen some draft on the Genius. Even in Genius, it will be prevented, even if. Bon. Voilà. Donc I think that's the main use case for now. Now we see a lot of actors which are looking at DeFi as a potential source of treasury, especially the big corporates. They see DeFi as a way for them to lock a rate of funding with their banks. So they get the cash, they tokenize it, or change it to stablecoins, and put it into DeFi. So they get a yield, and this is a kind of liquidity facility. But this liquidity facility is not validated by the banks when you use it, but validated by the treasurer itself. So he's independent in a way, and he gets 24/7 true liquidity source. And that's typically a use case that we see. And the others are linked to funds, because the funds, but in the end, they have to, let's say, find sources when they get a part of the funds, which is in stablecoin. And they need to either fund themselves to, let's say, adjust the collateral, or it's a way for people holding fund shares, voilà, to get revenues and to get liquidities. So this is the main capital market use cases, I can see.
Maybe just to complement on this, and I mean, of course, we are an FMI, so our customers are banks, and we don't have direct access to investors, but obviously the services we offer, they are highly dependent on the attractiveness for the investor community to adopt those services. And we can see traction in two areas. One is in facilitated access to private market investments. That's I think, one area that is an evergreen of sorts. And the other one being enabling investment customization at scale, which is not a new topic, quite frankly, but I think where technology can offer a new answer to an old problem, so to say, and allowing, for example, individualized, customized, as I said, investment strategies in a cost-efficient way for the investor without having to pay or to bother with complex structures, ad hoc structures, or fund structures, or similar. So that's an area that we are looking out of Switzerland currently a lot with the asset management community, for example, at scaling.
For the final few minutes, I would now like to move into a closing round, let's say, and therefore I would like to know, looking ahead to 2030, what will capital markets look like, and what role will on-chain infrastructure actually play? So maybe we start with you, Georg.
In 2030, I hope we'll establish on-chain infrastructure as the fundamental underlying infrastructure layer for all of global finance and other verticals. I think that it will allow firms to operate a lot more efficient, so you will see increased activity, and that ultimately is beneficial for markets generally, more liquidity and so on. So the often touted saying that just by bringing stuff on chain doesn't increase its liquidity profile, that's true in the short term, but I think it's not true in the long term. As people have more capital available to deploy, that will translate into better liquidity overall. So, I see really the world of finance and coming on chain, and from our perspective, obviously, coming onto Canton.
We didn't speak of yet of the US, but the US issued a very clear roadmap for tokenization and for bridging TradFi and DeFi. And considering the weight of the US in the traditional finance and the way they are pushing forward, etc., I think this new roadmap issued in 25, they made a really great job. So I think that this will be a part, let's say, of the engine we will see in the transformation engine. It's very clear. It's hybridization between TradFi and DeFi. Probably there will be a strong push from there. And in Europe, we see all the CBDC questions, so it's driving forward, let's say, the adoption. It's more linked to big actors, SIX being one of them in Switzerland, but Deutsche Börse Group, some banks, etc. I see it. I see the transformation, maybe not at 2030, but definitely the train have left the station, and thanks God it will go straight and accelerate.
Okay, 1 minute left. Maybe we get 2 more extra minutes. No? Okay. Then very quick, maybe was like some final words, very quick, please.
So maybe just one. Every single IBAN account will be doubled by your wallets, right? By 2030.
Fantastic. Well, let me just say, so the plumbing will be there. The market will use digital services without knowing they're digital services. But it will just work, so to say. At least for some first initial services, we should be able to do that. And I double down on what David said. There will be harmonization and productive-ready solutions for the big topics surrounding us today in terms of CBDC, in terms of digital securities, and so on, by 2030.
Yep, more efficient, more global. That's it.
Perfect. Still on time. Yeah, that brings us to the end of our discussion. Thank you very much for your insightful views, perspectives. Thanks a lot.